Flourishing annuity sales using reinsurance as a capital management strategy and rising competition from new market entrants continue to support activity in the U.S. life annuity reinsurance segment. That according to a new AM Best report. This Best Market Segment report is part of AM Best's broader look at the global reinsurance industry ahead of the Rendezvous des Septembre in Monte Carlo. We're joined today by AM Best Director Ed Kohlberg and Senior Financial Analyst Stratos Laskarides, who are here to discuss the report. And Ed, starting with you, what are some of the key takeaways from this year's analysis of the global reinsurance segment as it relates to the life annuity segment?
Sure. On the life and annuity side, we're seeing solid growth for the industry. Good profitability as well continues for the most part. When you look at the life mortality side, in force continues to grow for the reinsurers. Many of the direct writers sees a value in utilizing reinsurance in a post-COVID world. The annuity side, very robust growth for the industry for annuities on the direct side. And to support that growth, many direct writers are utilizing reinsurers to help support their capital. This is creating competition both on the direct side and also competition on the reinsurance side as companies look to aggregate these assets and aggregate the asset-intensive liabilities as well. For right now, there seems to be enough business to go around to support that competition. For M&A, for more block type transactions, that's very competitive. Even more so competitive on the life side. To support these liabilities, I think you need to think about the investments that are being used as well, especially for these asset-intensive businesses. Both on the direct side and reinsurers as well. They seek strong yields, and certainly where interest rates have been over the past year, that's helped to support profitability, help support yield targets, and help create a product that's been very good for the marketplace. And certainly there is a need in the marketplace for these products for both retirees and for MYGAs, multi-year guaranteed annuity products, which are selling very well. So on the investments that are being used to back those, we are seeing some heightened risk, right? There is some use of some private credit investments. Some of the direct writers utilize affiliated funds to help support yield. So these are things that we're watching, keeping an eye on closely. Capitalization for the industry continues to be robust. We're watching liquidity metrics and ALM as well.
Stratos, the life reinsurance market is historically top-heavy with a handful of dominant players. How's it reacting to the influx of new players?
Yeah, John. I mean, these more established reinsurers have focused on different markets to the new entrants. Generally speaking, the newer entrants over several years now have been focusing more on growing assets through like annuity sales. Generally speaking. Whereas some of these more traditional reinsurers have been focused more on like life reinsurance and biometric risks. And what we're seeing is these more established or long-standing reinsurers, that's many of which have European parents. They're responding in three ways. One is they're focusing more on their strategies. They're doubling down on those strategies generally and really staying in the lane of doing, life reinsurance, focusing more on the liabilities and liability-driven reinsurance in the US. Of course, the second thing they're doing is they are obviously monitoring, the competitors in general in the market. They're looking at ways to support some of these new entrants as well. In some ways, they might do YRT or risk premium reinsurance on the biometric risks. And at the same time, they'll bear in mind the counterparty credit risk. But generally, to the first point, they want to maintain their market shares in their core markets. And in the report, we show that it's as measured by metrics like face amount in force for individual life insurance or group life insurance, respectively. And I think the third thing also is they really just focus on being more disciplined around expense management, pricing, in-force management, and capital management in general. To support their goals. As I mentioned on the first point, their strategies have centered on how to further close protection gaps for life insurance risks and health insurance, and they're really focusing on leveraging their strengths. For example, they provide support on predictive pricing models that streamline customers' purchase experiences. In those three ways is generally how they've been responding.
Ed, how do you expect the segment to perform in the coming year? And is there anything in particular AM Best will be keeping an eye on?
Yeah, going forward, I think it's going to be a continuation, a little bit more of the same. With interest rates continuing where they're at, I think there'll still be a need for the annuity sales and the need for the reinsurance to help support that and help support the capitalization for the industry. We'll continue to watch the investment allocation. It seems like companies may have hit their percentage limits when it comes to some of these less liquid assets, but we will be continuing to watch that and continue to see how they are performing. We expect continued profitability for the industry. I think the key thing to watch is the capitalization, not just regulatory capitalization metrics or BCAR metrics, but also the quality capital is very important as well.
Thanks, Ed. Stratos.
Thank you.
That was Director Ed Kohlberg and Senior Financial Analyst Stratos Laskarides. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.